Well, good morning and welcome to today's Monday morning money briefing. It is a pleasure to be here with you all on this bright, well, not so bright, sunny Monday. I'm just going to share in the chat now a link to how you can ask any questions if you do have them whilst I'm going through this live session. If, of course, you're watching this recorded or at some point later in the week, you can always drop us an email at hello@myfinancialfreedomcoach.co.uk to ask us whatever it is that you might have. You can also reach out to us on social media. You'll find us on Instagram, LinkedIn. It's relatively easy, hopefully, to find us all. And you can ask whatever it is that you might have there. As well as, of course, if there's any headlines that you've seen that you want digging into a little bit deeper, do just let us know. Very happy to try wherever possible to dig into them as well. And this is, as you might have guessed, recorded, and we do make sure that we distribute the recording afterwards as well. So without further ado, I will leap into what we're all here for this morning. So if you're new, hello and welcome. It's a pleasure to have you here. It's always good to have new faces, but I know we've got some familiar ones as well, which is also fantastic as well. But the agenda will be one thing I've done to get a little bit closer to financial freedom this week, and one thing, therefore, that you can do as well before going into what's happened in the UK, over the pond in the US, before taking a look at a read of the week, Europe, and the rest of the world as well. So one thing that I've done this week to get that little bit closer to financial freedom is started to redirect an investment strategy. This is after some of the funds that I was invested in had their share classes closed. So this can happen sometimes, essentially, when you're invested into a fund that is provided by an investment platform. Sometimes, for whatever reason, the relationship between that fund provider and the investment platform can cease, or indeed the fund itself can close. These things aren't necessarily negatives. There's not anything to panic about, but sometimes it's just kind of the way it can go, in the same way that beauty products can expire or food products can change name, change the way that they are listed with ingredients. It's exactly the same with investments. So I got a notification to say that one of mine had closed, and what that meant is that I now needed to rethink my plan, because normally what I do is automatically reinvest into all the funds that I've got there, because it's just set up like that. So I needed to find an alternative to make sure that my diversification levels remained at where I wanted them to be. So the one thing that you can do to kind of keep this in mind, because it might not happen to you, particularly if you're a relatively new investor, it might be something that happens later down the line. It might not happen if you've not got loads of funds, or indeed if they just automatically move it over for you. I think the key takeaway for me on this one is make sure that you keep on top of any communications or emails that come from your investment provider or your investment platform. I know it kind of sounds obvious, but I don't know about you. Sometimes you can get so many promotional emails through. It's easy to just either skim through them and not read them, or just frankly hit delete. But what it could mean in the long run, of course, is that, as I say, if I haven't readjusted, the diversification of my portfolio would have changed. So do make sure that you keep on top to make any small tweaks that might be needed. On to then the markets for last week, where it's a bit of an interesting mixed bag. The FTSE 100, so the measure of the 100 biggest companies in the UK, ended the week up by 0.68%, just a little whisker in the green. The S&P 500, which is the measure of the 500 biggest companies in the US, ended the week up by 0.89%. The NASDAQ, which is the tech-heavy index in the US, ended the week up by 1.96%, so had a stronger week. But normally what we see with the NASDAQ is that it is a little bit more dramatic in its swings. It's a bit more volatile, and normally the ups are bigger than the S&P 500, and the downs are also bigger than the S&P 500. And then the Euro Stoxx 50, the measure of the 50 biggest companies across the Eurozone, ended the week down by 0.09%. Just a little tiny margin there for you. What last week really showed on the markets was notably the huge level of earnings reports that we saw come mostly out of the US. So just as a recap, earnings reports are when companies tell us how they're doing and what they expect from the next quarter. They're pretty important moments when you're thinking about a company's kind of performance and their stock performance. But when we're thinking about wider investing as well, if you're not investing into individual stocks, which many of us aren't, then it still has quite large ramifications on the wider market movements. Because often, particularly with big companies, they can really be the sort of, they call it like almost the bellwether, the thing that signals how well certain sectors are doing, how well the overall economy is doing as well. If certain groups of companies, think like consumer goods, those that we spend money on, do well or don't do well, or forecast that things are going to go well, or the opposite, then what that tends to show is a bit of a wider reading as well, which of course can really impact markets. So it's not to say that those earnings reports should just be ignored if you're not invested directly into that company, because as I say, they can have wider impacts. And last week there was just a big group of them reporting. So amongst them were some of the big tech names, Microsoft and Meta amongst them, as well as others too. And of course, Microsoft, Meta, amongst some other major names known as the Magnificent Seven, so 7 big companies in the US, really dominate that stock market in terms of how much of a percentage they are worth compared to all of the other companies. So the S&P 500, as an example, whilst there are 500 companies in them, it's not split up directly into 500th little chunks, but rather it's shown as how much those companies are worth. And some of the major companies, Nvidia, Microsoft, Meta, Apple, Amazon, Alphabet that owns Google, and Tesla being the last one there in the group. Gosh, I did so well to get to 6 quickly, then the 7th one just slipped my mind. Of the Magnificent Seven, what we've seen is that they hold a huge proportion of the US stock market. So their size is, in relativity, is a lot bigger. And it's something I'm going to come on to talk about more in today's market update. So hold that in mind. How you can use this is just keep checking in with those figures. As of last week, you probably won't have seen anything major or dramatic within your investing portfolio. And that can be maybe a good thing after some of the headlines that we're seeing, but it can help to understand what some of the swings might represent. So what's happened in the UK then? Well, it's been an interesting week for the UK, notably with Sir Keir Starmer, the Prime Minister's visit to China. He is trying to open doors to a potential UK-China bilateral services agreement, which is opening kind of all sorts of trade avenues and various different bits and bobs, for want of a better phrase, between the UK and China, and just seeking to strengthen different ties. If progress on this deal is made, then there are potential for financial, legal, and other professional services firms. So think the likes of consultancy, anything else that kind of falls into that bracket, could gain new growth opportunities in China. There's also potential talks of the likes of visas being open so that UK nationals wouldn't have to apply for a visa to travel to China for up to 30 days. So really opening some doors for potential business travel. Of course, within that, there might be some tourism, but what the visa-free or visa-less short-term travel is looking at is boosting some of those business opportunities. What the UK kind of hopes from this is that there are the more long-term earnings in sectors where Britain is relatively strong and has historically had quite a strong presence globally that has perhaps dwindled or suffered a little bit in the last few years post-Brexit, and of course just within the changing face of geopolitics. So what does this mean then for you and your investments? It's more of a slow burn. It's not necessarily anything that we'll see panning out or playing out within the stock markets unless something really dramatic comes and takes a turn within these announcements, which I don't suspect with Keir Starmer it shall do. He doesn't seem to be a man of drama. But what it could well do is show some strength in those longer term sectors and potentially therefore give them a bit of a short term boost on the stock markets. We see there financial, legal, professional, but we could also see some popping up around pharmaceutical and potentially even automobile as well. Who knows how far the agreement could go? With China's population, of course, being so vast and the growing levels of wealth there amongst the general populace, strengthening those ties could well prove to be relatively well-paying in the long run. So as I say, it's more of a long-run game. If you've got investments in the UK, you may well look into some of those certain sectors, but it might just be a glimmer of hope for what is to come for those overall investments. And next up, over the pond in the US, where several of America's biggest companies have announced large job cuts. This is as part of the slew of earnings reports that we saw come in last week. There's more than 52,000 roles set to be eliminated. These are across various different companies. It's not just necessarily in one, but some of the big names that stood out as announcing that they were going to be making redundancies were Amazon, UPS, Dow Jones, Nike, and Home Depot as well. So across the board there, from the tech giants like Amazon, Meta also announced some job cuts, through to services, UPS, as well as Nike, of course, a major sports brand and apparel company, and Home Depot too, a consumer goods company. It's not necessarily a sign of a weak economy, but it's certainly a sign of some uncertainty in the air. There's various different reasons for these job cuts, uncertainty being one of them, but also the ongoing AI chat about how it is not necessarily replacing jobs, but making things more efficient within companies that AI is then able to pick up. Signs of a slowing US job market matter, though, and they matter on a global scale. Of course, most of us here today aren't sat in the US, is my understanding, and so it's not something that necessarily impacts us directly. We're not necessarily worried about our own employment off the back of a US jobs report or what has been announced, of course, unless those companies do have global headquarters and you are sat in any of them, in which case it may well spread a little bit further afield. But why it matters is because US economic shifts often feed through. And this ripple of uncertainty that is coming from some of the biggest, most powerful companies in the world will inevitably have a knock-on impact into other major companies and also other major nations as well, and how they kind of see themselves in the standing. Historically, the US has always been a huge global economic power. So if they're struggling with potentially higher levels of unemployment and companies are needing to make layoffs, then others may well start to follow suit. It's not necessarily going to be the case, but it's certainly one to watch when we're thinking about our investments and also our own financial position. Making sure that you have your emergency funds set up, for example, as well as really working on your own investing portfolio can be one way to ease some of the nerves and stress around the likes of unemployment, which is something that's relatively unavoidable in many cases. The other thing to be aware of is that US economic shifts often feed through to other investments. So things like pensions, other portfolios, other major global funds that you might have might see the impact of some of these layoffs if it causes more uncertainty into this week as well. It's just that kind of ripple effect that we've seen take place with much more dramatic incidents over the last few weeks, but you start to see how it really impacts investments. And of course, over the short to medium term, how that could pan out within the job market. AI has been talked about as a threat. It's not going away. It's just part of digesting how that fits within the overall job market in the short term from an investing and financial perspective. When the internet first arrived, for example, there was a lot of the same talk as to how it would replace jobs and lots of people would be out the market. Temporarily, of course, that was and could well be again the case. But usually what happens is that there's a period of wobble and then it starts to filter through and people remain in various different jobs, just shifting the direction. Who knows, of course, none of us have a crystal ball, but that does seem to be where this news is pointing for our investments this week. On to then the read of the week, where the Financial Times dug into what you should do with the income from a share sale. The article really goes into how to manage investment gains under slightly changing UK tax rules. Now, often what this can mean for us is that you're using the likes of ISA allowances, if you can in the UK. So if you're a UK taxpayer, you can use what's known as the ISA individual savings account, and you can use a stocks and shares ISA to invest into stocks and shares. This means that you can put up to £20,000 per tax year into an ISA, and all the gains and dividends are tax-free. Now, if you hold shares outside of an ISA or indeed outside of a pension, you will need to pay tax on it. And you may or may not be aware, but in the UK, you have to report your tax on this. It's your responsibility to do so via a self-assessment tax deadline report. Now, the deadline for that has just passed for the previous year, but there's still time to get on it for the next year if that is something that you need to do. Sometimes people hold shares outside of these products because, for example, they're employed by a company that gives them shares as part of their employment deal. This can mean, though, that there are various different tax mitigations that need to take place, as there are lower dividend, £500 now per year, and capital gains allowances, £3,000 per year, that are set out. Some may also look to use the likes of EIS investments. So these are relatively efficient investments into startup and new companies, whilst others might look to do things like spousal transfers, whereby you use each other's tax-free allowance to be able to make sure that you're still taking benefit of what you can. But it's all about avoiding short-term tax-driven mistakes. So wherever you are in the world, there's something to take away from this, which is essentially that there is always ways, there are always allowances that we have to make sure we're taking advantage of. It's not tax evasion, it's not doing anything wrong, but rather the government have put there to incentivize people to do certain things. So with the case of stocks and shares ISAs, for example, it's not avoiding tax by using your £20,000 per year allowance in ISA. In fact, what you're doing is investing, and that is ultimately what it's been put there for, and the government want people to do with that incentive. So make sure that if there are incentives that you can use, you are using them. It both benefits you, the government, and the wider economy as well. So let's take a look then at Europe, where news around the Eurozone economy was very, very positive. In fact, it was shown to have grown by 1.5% in 2025. This is compared with just 0.9% in 2024. So it really not only surpassed the previous year, but it also surpassed forecasts. Most at the European Central Bank had forecast a growth of around 1.3%. A lot of this positive growth towards the end of the year was appointed to all sorts of different reasons. Unfortunately, France was one of the slower growth economies, but Germany, Spain, and Italy made up for it, therefore pulling up the overall growth within the region. But this steady economic growth and a little bit of positivity reduces the immediate risk and fears of the likes of recession and also the geopolitical tensions that are taking place and the impact of them on potential economies. This can really boost a bit of positivity, and contrary to what we've seen in the US, where layoffs are taking place, this kind of data can really help to support employment and incomes. If European companies are looking across the pond at various different companies in the US making those redundancies, then they're probably thinking, well, things were looking pretty good here last week. I'm feeling a little bit more positive. Whilst, of course, we are interconnected as a globe, not everything has to be the same. Over in Norway, then, we saw the Sovereign Wealth Fund of Norway, which is essentially a fund owned and run by the government, gave its earnings report. Now, the Norwegian Sovereign Wealth Fund is a really, really interesting one. It's worth a whopping $2 trillion. But it has warned that extreme shocks could severely damage its portfolio. It did make $247 billion in 2025 alone, so I'm not too concerned for it. But what this does show is that even the biggest funds are having some fears and expressing those worries right now. The Norwegian Sovereign Wealth Fund has significant holdings in various different tech companies, including having a 1.3% ownership of NVIDIA. I know it doesn't sound very much, but when you consider the size of NVIDIA as a company, this is an absolutely vast investment quantity that they have in that company. But what it does really show is a real concentration risk. Whilst around 75% of the fund is in equities, so in stocks and shares, a lot of these are concentrated in tech and AI-leaning ones. So whilst another 25% is, of course, invested into alternatives, be it bonds, be it precious metals, you get the idea of the commodities. That remaining 75% hinges a lot on stock market performance. So never, ever underestimate how big or small some of those shocks can be. If you're ever looking at somebody thinking the grass is greener, that, oh, the more that you've got, the bigger your portfolio, the less likely it is that you suffer from shocks or ups and downs, it's not necessarily true. So what this means for your investments is that starting wherever you are with however much it is always a good thing to do. It's not the case that the more you have, the better it gets. Now, of course, it becomes easier and the compounding gets quicker, but it can also still mean that you suffer from some of those swings. So don't do yourself down if you've been looking over the last few weeks at your investments feeling a little bit battered. And last but not least, onto the rest of the world. Well, first up, AstraZeneca, the British company, has agreed a licensing deal with China's CSPC Pharmaceuticals to develop new weight loss and diabetes treatments. Pharmaceuticals are on a constant conveyor belt, if you like, to constantly refresh the patents that they have around different drugs as these expire within a certain period. Weight loss drugs are going to start to come up to these patent expiry periods, and this can often mean some stock volatility, and it can also mean that the company can rapidly lose an awful lot of money, as suddenly loads of other companies can clone what was exclusively theirs before. What's happening with pharmaceuticals more and more is that they are looking towards the likes of China, where there's been huge levels of development and innovation hubs within particularly pharmaceutical areas. This is therefore appealing and attractive to try and develop new drugs that can be patented, again, to keep the company afloat. Now, AstraZeneca has also listed this week on the New York Stock Exchange. It already had a listing in the British Stock Exchange, but it's now listing itself on the New York one. When companies are particularly big, they are able to do this. They split themselves up, they have different subsidiaries, and they can list on multiple stock markets across the globe. This can mean that they can open themselves up to more investors. So they're really looking to boost, to go to the next level and to push from strength to strength. So what does this mean for you and your investments? Well, it's an interesting one to watch. If you are somebody who wants to have more specific focused investments in the likes of pharmaceuticals, for example, then you'll be well familiar with the likes of patents and how they can impact share prices. But if it's something that you're just in the initial research phases of, then it's certainly something to bear in mind as to how much this can impact the overall view of a certain sector and what regulation changes can really do. On to then Indonesia, where Indonesian equities fell sharply over 2 days last week. The Jakarta Composite Index, which is the major stock market index over there, dropped as much as 16% amid a flurry of fears. These fears were really stoked by a report around transparency on the stock market and potential meddling. Nothing has been proven yet, but it seems to be that various individuals high up within the stock market have already resigned. This is a real indicator of what and how quickly things can change within particularly more emerging markets and newer stock markets and indexes as well. If you've got emerging market portfolios or funds, you'll probably have some Indonesia exposure in there. Now, this likely won't have caused too much of a ripple if it's a well-diversified fund, but it does show the risks of investing into individual emerging markets, particularly if they do see, for example, issues with corruption and lack of transparency. And last but not least, on to Abu Dhabi, who have consolidated their state holding company ADQ into Lamad, which is a sovereign wealth fund, there it goes again, controlled by the Crown Prince. Now, this is a move that is seen to be a shift in power within the royal family in Saudi Arabia, but also an indication as to how some of these sovereign wealth funds can run and be controlled. They can be worth so much money, as we've just seen with the Norwegian sovereign wealth fund. And the Abu Dhabi one is no exception. It's not quite on the level, is my understanding yet, of the Norwegian one, but it may well seek to head that way too. It owns various different state companies too that belong to and are based in Abu Dhabi. So it's certainly a way of keeping things under thumb, if you like, and all within the same country. So what does this mean for you and your investments? Well, it's not necessarily one that will impact you directly, but it's one to keep an eye on, particularly within those more emerging market portfolios again. Abu Dhabi and other Middle Eastern states are really emerging and popping up as areas of growing wealth, growing economic development, and growing stock market development as well. If things become too consolidated within one country, this can really impact overall returns. Unless you're investing directly into it, again, you might not see it, but it's certainly one to be aware of when thinking of broader investments that are a little bit more risky within your portfolio and what that could mean for you as an investor and your overall strategy as well. So I'll move now into the questions. If anybody does have any, do just pop them in that Slido link. Very happy to answer anything it is that you might have this morning. I can see one has come in, which is fantastic. If governments keep increasing the retirement age, which is a lot of talk at the moment, you've read that it's around 70 for the Netherlands. Does it make sense to put money into a private pension pot? It's a great question, and I think it's one that all of us can have a think about this morning, because it's likely to be one that continues to be spoken about, particularly across Europe, as we see, for example, more and more spending be prioritized on defense with current geopolitical tensions, and what that could mean for other areas of government spending, like the state pension. Now, in terms of whether it means putting money into a private pension pot is a good idea or not, depends on what that private pot looks like. So if there are restrictions around that private pension pot, like you can't access it also until you're 70, like the state pension age, or until you're 65, but that could change, this might mean that it's not so appealing. I'd have a look at the tax benefits around the pension pot that we're talking about here. So you've mentioned the Netherlands, for example. It'll look different for anybody that is sat in the UK that has access to a UK pension pot. Now, if the private pension pot in the Netherlands comes with certain tax benefits, it might be more appealing than just keeping your investments on, for example, an investment platform where you're exposed directly to relatively high levels of tax, and therefore the inflexibility that you might have with that pension is kind of weighed up by the lower levels of tax that you might pay. Now, what I kind of say to that is it's all a balancing act, right? It's about making sure that you've got provisions for your future. Often what people do is they ladder up almost. They have some in a private pension pot, they've got some in their own investments, and then they know that at some point down the line, they're going to get their state pension. And it almost works in, like, as I say, a ladder, a trigger zone. That first pot that is the most flexible might be one that they start to access while they're going down to part-time work, for example, still doing a little bit here and there. That later one might be one when they go to full retirement, and then the state pension kicks in much later, whenever it does kind of date. But those provisions are set up in such a way, if that makes sense. And then another question just come in about what industry would you watch in these weeks? Oh, big question, and I love it. I'm here for it on this Monday morning. I think for me, in terms of industries to watch, firstly, it's always worth saying it depends on what your strategy is. For me, some really interesting industries that are popping up at the moment are, of course, defense. I've touched upon it already, not so much this week, but with the geopolitical tensions and government spending around defense going through the roof, it is certainly an area that will be and has seen significant growth into 2026 and last year as well. I think other industries that I'd also be keeping an eye on are the likes of pharmaceuticals, weight loss drugs, weight loss pills, and how they're booming. Perhaps not one in the next few weeks, but certainly into the next few months, years. And then, of course, AI. I'm watching it. We're all watching it, right? We're all thinking about what it means, probably almost on a daily basis. We might well even all be using it on a daily basis. And that goes to show why we're all watching it from a stock market perspective as well. So I think for me, they're certainly ones that I would be keeping an eye on and thinking about what they meant. Last but not least, it's not necessarily an industry, but gold, silver, metals are on absolute whirlwind. I'll try and throw it into next week's market update for us, but it was a bit too fresh this week to try and get something in because there was some real curveballs that took place. One more. What about metals? Looks like such a roller coaster even there. It looks like somebody read my mind. So I've just read that question. Yeah, what a week. As I say, it's just been a bit too soon to try and digest and take in what happened towards the end of the week, particularly with the price of gold, which for anybody unaware, it hit all-time highs all last year. Gold kept hitting all-time highs, same again this year, over $5,000 per ounce. And then suddenly there was a bit of a plummet. I suspect a bit like anything that this is all tied into overhype, a bit of a bubble again, but just wait. I'll get it into some digests for the week coming up because there's certainly a lot that could be said about it. For anybody that's unaware, a lot of investments are flocking into gold, precious metals and the like, because mostly people are looking for something that they can really attach onto. They want something that they can understand, and gold represents a investment that's been there for years, essentially, centuries, decades, centuries. And whilst all these turbulent times are taking place, it's something that is a little bit different. So I will leave you all to your Monday, your week. Thank you so much for joining me this morning or whenever it is that you're watching this recording. Thank you for coming along with all those questions as well. Have a great one, ladies. See you all soon, and bye for now.